Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, so I'd like to start today's lecture with a discussion of the general feedback on your assignment 1. Especially, I'd like to give comments on several points that will hopefully put you better on the track to think like an analyst. So we have spent so much time talking about the historical accounts and the importance of reorganizing the reported accounting items into our KGW model. So I have highlighted all of the key material errors or some inaccuracies in your historical data. If you're not clear of anything, just come to talk to me. It's very important to understand these basic financial statement analysis skills for your future development as well, especially for students who are thinking about doing the CFA exams. Now I'm going to focus on the forecasting side of your assignment. So if you imagine how much parameters or forecasts you put into your KGW model, there can be hundreds of numbers in there, but they can be grouped in several categories: the cash flow related, the discount rate related. But they are all fundamentally connected to your understanding of the business operation, how they have a profit margin of 5 to 6%, how do they have a capital turnover of 3 times, around that range, depending how well or how accurate you define the historical data, and why the spread of ROIC over WACC in the past several years have been stable and at this level, and your understanding of all of these drivers of value will fit into your forecast. Actually, nothing from the historical data will explicitly fit into your valuation at all. So one observation from assignment 1 is the overplay of historical data. It's true that we only have the historical accounts or historical stock price to estimate beta, but they can only provide an indication of the risk of the company or provide indication of the margin of the company in the past several financial years. What we are focusing in valuation is actually what the company strategy in place and what will the competitive structure of the industry will be in the next several years, or what will be the economic outlook of Australia will be in the next several years. And all of these factors are going to play with each other. The company does not operate in an isolated environment, or if at the financial year end, the board of directors and all of the senior management will sit together and they will not say, okay, it's the end of the year, we have a very good performance from financial year 2018, we are so well positioned for the next several years and we don't need to do anything. We have a good trend. That trend is actually, behind the trend are the corporate strategies they have in place, the efforts they put in there to attract more customers to shop at Woolworths shops, and the efforts they put in there to restructure the overall business structures, the overall within their group. So, and of course, the trend will incorporate these very specific strategies, tactics, approaches of the company. Of course, it's driven by some fundamental factors like the robust economic development in Australia, that investors are generally confident to spend money, and you will see the revenue steadily increase in the department stores, or consumers are spending more money on the takeaway food or on the wines or beers. These more discretionary items. So no company is sitting or operating on the trend line or average or historical average. There's always such interaction between the company's strategies, the industry competitive structure, and the general economic development of the whole country. So any forecast model simply based on a historical average revenue growth will be poorly specified. This is from example I discussed in lecture 3. So the first forecast of revenue is solely dependent on an average, historical average revenue growth. So if you look at the number, they might be reasonable for mature industry or for this kind of, for this company, but what's behind these numbers? You are simply assuming the company in the next several years of the forecasting period will be exactly the same as the historical data you try to draw the information. They're going to be exactly the same corporate strategies, exactly the same industry structures, market share, margin, nothing will change. And you assume exactly the same general economic development. As a proxy, we sometimes use GDP, although there are several indicators, like for the cyclical companies, building materials, so you may look at purchasing manager index, capacity utilization, all of these parameters. So if you do forecast the revenue growth at the historical average rate, you are assuming these years will be exactly the same as the history. Ask yourself, is the case for Woolworths? We have spent so much time discussing the threat within the industry, the competitive pressure within the industry from Coles, from Aldi, from the wholesaler, Costco, and possibly from Amazon as well, maybe down the track in 10 years of time. So nothing will stay the same in the future. This is not a forecast model at all. This is just simple manipulation of historical data. Another flaw of your forecasting model is to try to incorporate the fundamental drivers. For example, economic development, GDP growth. Very specifically, a few groups have used the forecasting method of inflation rate plus the real revenue growth rate. And within the model, they didn't incorporate anything of the company's corporate strategy or the industry competitive dynamics at all. So they're going to forecast the revenue growth will be an expected inflation 2% plus a real GDP growth rate of another 2 or 3%. So they're going to forecast the revenue growth for the next several years of 4 to 5%. Okay, I'd like to think about this forecast method. What's the problem with this? It's true that any companies with an exposure to Australian economy is exposed to the risk uncertainties of Australian economy. But is this reflected in the revenue forecast in this way? If you look at the revenue growth of Woolworths in the past several years, and you have inflation plus real GDP growth at another row and compare these two rows of numbers, you will find they do not agree with each other. Because the the revenue growth of Woolies is the net result, net outcome of the corporate strategy, industry competitive advantages, and the macroeconomic development. But if in your model you only simply use the real GDP growth as the proxy of real revenue growth, it's obviously poorly specified revenue growth for the company. Because of the nature of the business or the nature of industries, companies may benefit differently. They are going to reflect of different degree the robustness of the economic development in Australia, some companies may benefit more. You're going to see their revenue growth much higher than the real GDP growth rate, and some company might be very similar to the real GDP growth. Some companies might fluctuate a lot. They're going to go up, down with the business cycle. So simply using GDP growth rate as proxy of the real revenue growth rate of Woolies is not a good model. At least within your forecast model, you need to introduce firm-specific strategies, like the market share or any margin changes or capital turnover. You forecast the company will benefit from this robust economic growth. If you are following the economic development in Australia, yesterday, the Governor of Reserve Bank of Australia just made the announcement of the Statement of Monetary Policy. It's a very brief but concise description of the Reserve Bank's interpretation of the recent development in Australian economy. So all of these will feed into your forecast model, not just the real GDP growth. This is another flaw of your forecasting model. Another flaw of your forecasting model is the misunderstanding of the top-down method. So Woolies is actually fit into this forecast method very well because it has very clearly defined business segments, and each business segment competes in the sub-industry of the retail. To my surprise, I found several groups had difficulty locating the retail data. So I like to still oh. So from ABS website, you might simply go to retail trade. You'll find the definition of the industry, they report in the retail trade turnover in the exploring notes. So obviously Australian food, that's the business segment of Woolies, will compete in this sub-industry of supermarket and grocery stores of the food retail. So let's have a look at the data. So that's the list of spreadsheet that contain all of the turnover of all of the retail industries and sub-industries. So if you look at this retail turnover by industry group, from here you're going to have the total value turnover of food retailing. But it's too big for Australian food. That's the business segment of Woolies. So you need to scroll down to the retail turnover state by industry subgroup. Let's click over here. Looking for data that's for your quantitative analysis is something you must learn as an analyst, no matter an equity analyst, management consultant, or any other analyst job. So on this list, you will find supermarket and grocery stores, and liquor retailing. That supermarket and grocery store will be the sub-industry group that Australian food segment competes in, and Endeavour Drink in the liquor retailing. And also Big W its sales will go into department stores. These are the major sub-industry of the retail that Woolworths are exposed to. So if you're looking for a market share of Woolworths, for example, it's food retail, it's going to be $38 billion. That's the revenue from Australian food, divided by the number you read from here. That should be well above 35%. So this is really big market share. That's how you can get the data from ABS. If you are interested in running something similar for New Zealand food, you might go to Stats New Zealand. You will find very similar reporting of retail industries and sub-industry groups that you can calculate the market share of Australian food for Woolies. Maybe not that spreadsheet anymore. So that's the top-down method. You forecast a market share for Australian food. For example, in the past 2 years, the market share of Woolies has been 37%. And based on your understanding of the company corporate strategy and also the industry competitive pressure, and what market share you're going to forecast for Woolies, especially for the next 5 years. This will fit into your top-down method of forecasting the revenue for Woolies for its Australian food retail segment. So this is the top-down method. We forecast the industry turnover and we cut this industry revenue into several pieces and assign one piece that you will believe most likely the market share for Woolies, and that's your forecasted revenue. And it's better you apply the same method to other segments as well. It's possible for the other segments of Woolies, but for any other industries or companies, you probably will have a highly segmented market structure. So maybe one single company only accounts for 1%, 5% of the total industry turnover. Forecasting of the market share in this way might give you, may amplify the error in forecasting. So it's the top-down method is more appropriate for industries or companies that have segmented industry structure. Another way of forecasting revenue for the company is still not really the general big macroeconomic indicators. We can focus on the company's operation. So consider how the company generates revenue. So they build retail shops, no matter it's food retail or liquor shop or their hotel, that provides the leisure entertainment services to the customers. They have these shops, physical shops in place. So these are kind of fixed investment already. So the more customers you have visit for one single retail shop, the more revenue you have, and the higher margin you probably will generate, because much of the fixed cost will be still there, and the higher value you may generate for shareholders. So another way of modeling the revenue of the company is by looking at the retail shops for each of its food retail, liquor, and other business segments. Management does provide very detailed information of their store rollout plans. So your forecasting of revenue can be based on the store rollout. But there's a catch in this method. That not in Australia, in Canberra, we understand we are building several new suburbs. We might see a few new shops called the Woolworths. Consider this. It's a new suburb. And you build and open a new Woolworths shop. Do you expect the revenue in the first 5 years will be the same as existing shops, as in Gungahlin or as the shops in Canberra Centre? No. And if Woolworths decides, okay, Canberra Centre is such a hot spot, and there's demand of grocery shops, they're going to open a new shop in Canberra Centre, maybe just opposite Coles or just next to Aldi. So think about this. The people in the nearby suburbs of Canberra Centre, they have been shopping with Coles or Aldi or other small independent grocery stores for so many years. And most of the family have joined the reward program, of course. What's the reason of them going to shop at Woolies if you open a Woolworths shop next to Coles? That's a new shop. Do you expect your revenue will be the same as existing Woolies shops? No. It takes a few years to have the committed customers, and it takes a few years to have the customers to be converted to shop at a Woolworths retail shop. So when you try to model revenue growth, and especially the new shops, it takes a few years for them to generate the average revenue per store. So make sure it incorporates this into your forecast model. You might be creative in terms of the way you incorporate this discount. I'm not trying to prescribe a correct way. You should find out the way yourself. This is learning by doing. Okay, these are the major problems of the forecast model: overplay of the historical data, and much of the industry competitive pressure has been ignored in your forecast model. Even if you try to incorporate the fundamental drivers into your forecast model, make sure you understand that food retail, liquor, they are driven by different things. With the food retail, the grocery stores, they're mainly selling the everyday essentials and milk, eggs, and other everyday necessities. But what about the liquor? The Endeavour drink segments, they provide alcohol to restaurants, or they have retail shops as well. So these are much more discretionary to customers' consumption. So if there's a very robust, very strong employment rate, or very robust disposable income or real wage growth in Australia, you probably see people would like to buy more alcohol. Or sometimes the shift of customers' taste might boost or depress the revenue in their Endeavour drink business segments. Australian have actually at the bottom of alcohol consumption in the past several decades right now. So people might be more conscious of the risk of from alcohol, or maybe they're shifting to something else, especially with the young adults. It's been reported that they are prone to not really strong liquor. They are drinking more alcoholic drinks, like the cider, this kind of drinks. So the shift of customers' preference or taste might be driving this revenue growth as well. It's even if for the second assignment you don't want to change much of your forecast model, just have a think of these possibilities. It's a good exercise as well. Another problem of the general assignment is the WACC estimate of still overplay with the historical data. For all of the parameters you put into the WACC estimate, every single number should be forecasted. Every single number here. So it's risk-free rate, the beta, equity risk premium, cost of debt, and capital structure. every single thing should be forecasted. So it's common observation of the assignments that you do, you calculate the implied effective interest rate and plug that in as the pre-tax cost of debt. Numerically, it's going to be very close if you use the implied rate or effective rate, because currently RBA has no plan to move the cash rate immediately, and according to the analysts' consensus or people's belief, the earliest movement of cash rate might be mid to end of 2019, even 2020. So it's very likely the yield will be just still at this current territory between 2.6, 2.7, maybe a little bit higher, because it will go up. Maybe driven by the interest rate movement in the US as well. So it's still at very low level. So plugging in a number of 6% of cost of debt, numerically, there's no problem at all. But using a historical implied rate or interest rate is not forecasting. You have to think about what will be the likely interest rate the company is going to pay if they issue additional notes in the US market, or if they want to borrow additional funds from Australian banks in the next 6 months or 12 months. That's forecasting. What we require here, cost of debt, is the interest rate on the marginal debt. To take on more debt, there will be additional risk for the company. With Woolworths, you won't see this significant increase of risk if they decide to take on more debt, additional debt. But for some companies with a high leverage ratio already, the marginal debt they take on will increase the overall risk of the company, and that will fit into the required return of equity as well. So that's forecast. With the capital structure, make sure you read the capital management section from the latest annual report, have some understanding of the intention of the management. Do they have intention to retire the over $2 billion of long-term debt, or do they have intention to shift the structure of their borrowing, like have more short-term debt, retiring more long-term debt and use short-term debt, or do they have plan to use more long-term debt instead of short-term debt? All of this will fit into your forecast of capital structure. Although manipulation of the historical average will give you some indication, but what the numbers you input here are forecasted capital structure or target capital structure. The same, there's not much calculation of, okay, yeah. With the beta calculation, all of your regressions, no matter how fancy you run the regression or how thorough you run over different sample period, over different data interval, no matter how thorough you run the regressions, they're going to be still based on historical data, historical returns. What happened in the past 10 years, that's not going to be exactly the same for the company in the future. So the reason that we run the regression to have the historical beta, especially we run the beta to generate a rolling beta trend line to give you some indications of the changes of company risk over time. Especially, you have to understand the changes of risk given the changes within the industry and the corporate strategies in place. Especially for Woolies, the past 2 years, rolling beta will be more relevant because they have been restructuring, and in 2016 and 15 they really had a big struggle. In the past 2 years, the company sort of has turned around, and we do have robust outlook for the next few years. For the latest 2 years, beta will be a better indication of the future risk. The reason that I provide the comparable company return data is to try to help you understand the relative risk of Woolies to the competitors, especially Wesfarmers. Wesfarmers is a diversified portfolio of food retail, fertilizer, energy, and a lot of things. And if you have run the regression, you will see that Wesfarmers beta is higher than Woolies because of its risk exposure in other industries. So when you run the regression and have the beta estimate for your company and for the peer group, make sure you understand you can justify the differences and the relative risk of the company. This should be part of your forecast of Woolies risk or beta as a proxy for the future. There are several technical errors in the estimation of WACC. I've highlighted all of them, so make sure you correct them in assignment 2. Basically, these are the most important things that you should be aware of for the assignment 1, and it's still a key component in assignment 2. It's the key core valuation of your composite valuation table eventually. The multiple valuations, the asset-backed valuations, or any other valuation techniques you are going to apply are supposed to complement this enterprise DCF valuation model. So this is the makeup lecture from last week. There are on top of the multiple valuations, there are other valuation techniques that we may apply, especially on top of the multiple valuations and the enterprise DCF valuation model, to round up our valuation, round up our understanding of the company's value. So we have the asset-backed, the price to book value of equity, price to net tangible asset value ratio, and also sum of the parts valuation or takeover valuation. The reason that we might apply the asset-backed valuation techniques is that actually we can't view a company as a collection of assets. So each asset's got its own fundamental drivers, its nature of business, operation, or its risk. And why not we value them separately? Or with the asset-backed, we can have a look at the relative pricing of the collection of assets to its peers or industry average, so that we can have a better understanding of the value of the company. So with the price to net asset backing, we have two categories. The first one is price to net book value of equity, and the second one is price to net tangible assets. It's true that we can calculate these ratios for all of the listed companies when we have data, but they may tell quite different stories. And these ratios can be more appropriate for a group of companies or industries, but not appropriate for another group of companies or industries. The price to net book value of equity is usually you will read this from the analyst analysis or some academic papers that they try to define value of relative value of firms, price to book value. That's the price to book value ratio. So it's calculated as the price, current price, divided by the net book value of equity per share. How do we get that net book value of equity? So we should understand that why balance sheet should balance, because with the purchase that the fixed asset investment of total assets is going to be financed with equity and debt. So price to book value will be this. So on the balance sheet, the price to book value is a ratio of the price of the company per share to the book value of the equity. That's the balance sheet. It's not market value of the equity. It's the balance sheet. How do we understand the book value of equity? It's true that we do take a very long-term view of any company we try to value, but this got a start of the company. When the IPO started, okay, the shareholders provide this amount of capital to make the purchase of the assets, and it's going to be recorded on the balance sheet as paid-off capital. That's the book value of equity. And that will be equal to that minus debt. So at any point of time in life of a company, we can estimate the book value of equity by that net total assets. Net total assets. It's a result of the original purchase acquisition cost of these assets minus the accumulated depreciation. That's actually the book value of your asset. Or very intuitively, you may consider this as the PPE. That's the only asset the company has, and that will be the book value of PPE. So that book value of equity reflects the net book value of the assets of the company. Why it's important for shareholders to understand the value of the company? So with the paid-up capital, I've paid for every single dollar of equity to purchase the PPE, the assets of the company, and it's going to generate profit, and it's going to be reinvested back into the operation of the company, generate additional more profits and reinvestment, and that's how you can generate value. And that value will be reflected in that price. That's the price. That's still the current net present value of all of the cash flow generated by the assets, which was financed with the paid-up capital of shareholders initially. So the price to book value equity reflects how much franchise value the company has generated over the years. So that book value represents the original $1 equity that shareholders has contributed into the operation of the company. And now that's the price, that's the value of that investment. What's the price to book value for Woolies right now? Do you have any memories from reading the data? The latest price to book value of equity, price to book value, is 3.5 times. So how can we understand that number? Okay, so that means for every dollar of equity paid up capital as the initial investment into the company, it has grown into $3.5. That represents 350 times of return for the shareholders. It's at a price to book value premium. So that's how we understand price to book value. Another asset-backed valuation ratio is the price to net tangible assets. Why do we care a lot about tangible assets? With a lot of media companies like Consolidated Media, that's an Australian firm, Fairfax, News Corporation, they have significant amount of intangible assets, the brand names. Or you actually, if you look at the even consumer companies like Coca-Cola, they have huge billions of dollars of intangible assets in the form of brand names. So the valuation of intangible assets can be very controversial and subject to the manipulation or accounting rule changes. So analysts would like to find out the valuation of the company, excluding the intangible assets. So that's why we may calculate the price to net tangible assets value. So with that price to tangible assets, we look at the premium of the price you pay for every dollar investment of the tangible assets. That's really the things that you can touch, that you can see, and they physically exist in there. These ratios are supposed to provide supplementary information, especially to the DCF valuation model. Especially for a very special group of companies, the price to book value equity is much stronger, much more useful valuation technique. They are the banks or real estate investment trusts. I'll just use the banks as an example. So for for consumer staples like Woolies, you can argue that, okay, that's really just a book value of assets. That's how you're going to calculate the equity value. So it doesn't reflect any cash flow generation ability of the company. It's not a good measure of value at all. But for banks, this can be a very good measure of value. Because for banks, when you look at the asset, the loans, so we're going to have loans. Do they have significant depreciation of the banks? No, they don't. So for banks and some financial institutions as well, especially when they have loan portfolio and deposits, and you will see that will be the deposit. The book value of equity will genuinely reflect the loans, the net of the loans and deposits. So to price the loans with banks, they don't just calculate the total amount of loans outstanding to go into their balance sheet. They are risk weighted. So when they have made this $1 billion of loan, they have to incorporate the possibility of bad loans in there. So that's how that's a risk-adjusted valuation of loan. So in other words, they are financial assets matched to market. That's the market value of their asset instead of a book value of PPE from any manufacturing companies or any other industries. So for banks, the book value of equity is a good reflection of value for shareholders. That price to book value ratio will be a good valuation technique. And also, this similar analysis can be applied to real estate investment trust as well. Why? Because their assets now will be properties. So real estate investment trusts, they develop and manage investment properties, their assets largely will be a very diversified property portfolio. So they probably don't value these properties every month, every day, but they do have a valuation of the property portfolio at least every year in their annual report. So any revaluation, the appreciation of the property portfolio, any downside of the property market will be picked up by the value of the property portfolio. And then the equity value on their balance sheet will reflect the changes of the assets that's generating cash flow, or in other words, value, directly associated with the value of real estate investment trusts. Okay, I still have a few minutes. So with the price to book value ratio is another framework to help us to understand how it can be useful. If we take a very long-term view of the company and we assume a mature industry, a mature company, there will be a constant growth rate of its dividends. And as the shareholder, I have no intention to sell the shares. I'm going to hold the shares indefinitely. So we can price each share as a constant growth model of its dividends. And K here is the cost of equity, and the G here is the constant growth rate of dividends. It's a constant. So we can play with this equation and with the payout ratio, multiply the payout ratio with earning per share for dividends per share for the next period. And we're going to have this ratio, divide both sides of the equation with book value of equity, and we have the price to book value ratio in this equation of return on equity, payout ratio, cost of equity minus the constant growth rate of dividends. So the price to book value ratio is an increasing function of the return of equity of the company, payout ratio, and the constant growth rate, and decreasing function of the risk of the company, which is similar intuitively as the PE ratio. And if we understand that the company can only grow its dividends by successfully reinvesting, so payout ratio or retention rate will be a part of the equation, and we plug this back into this equation and we have this. So the price to book value ratio will be determined by its relative spread of return on equity and cost of debt. The G here is the constant of its growth rate of dividends. So if the return on equity exceeds cost of debt, you're going to see a premium of price to book value. And if the company is really struggling to have a return on equity similar to this level of required return on equity, and you probably will have valuation in price to book value as 1 or below 1 or discount. We don't have time to finish the rest of the discussion. I'll just continue tomorrow. Tomorrow, the makeup lecture, I'm going to finish the discussion of the asset-backed pricing and give you some hints or tools on the scenario and sensitivity analysis. If we have time, I'll talk about some specific issues of doing the asset-backed or multiple valuation for assignment 2. Thank you very much.